Good day. This is Jim Turner, the business value guy. I'm the president and founder of Turner Business Appraisers. And I want to talk to you today about a question that comes up quite often whenever I get a phone call or an email from a potential client wanting a valuation. And one of the questions that always comes up is, how do you value a business? What are the business drivers? What's going to make my business worth more money? What are the value drivers? And so today I'm going to share that with you. 3 or 4 items that I will tell you drive the value of every business. Number one, the number one value driver is cash flow. The old adage that cash flow is king is truly at the heart of business value. And it is absolutely true with business value. And you may say, well, what is cash flow? Cash flow is simply after you take your sales and subtract out all your expenses, what do you have left to put in your pocket to invest in the business? It's discretionary. So the earnings that you have left over. And so cash flow is the absolute essential catalyst behind of the value behind a business. It's not revenue. Often folks will call and say, hey, I've heard that my business, I heard a competitor say my business is worth 1 times revenue plus inventory. And that is not usually the case. And I'll give you an example. If you're going to buy a business and they both have $5 million worth of revenue, but one of them has $1 million worth of cash flow, and the other one has $500,000 worth of cash flow, you're going to pay more for the business that generates $1 million worth of cash flow, assuming they're in the same industry and they have this similar product mix and everything else. And so it's not revenue that drives, it is cash flow. So cash flow is king, number one. Number two is the quality of that cash flow, or we call it in valuation, the quality of earnings. And so the quality of earnings gets at the heart of, how is that cash flow being derived? Is it cash flow that can be depended upon? Is it recurring? How likely is that cash flow to continue in the future? How likely is it to continue without the current ownership at the helm? And let me give you an example that will help drive home this point. So I was representing the seller of a landscape firm, and the buyer told us, look, we'll pay you 5 times earnings for your maintenance revenue and cash flow. Cash flow, basically, your 5 times your revenue or your maintenance cash flow. And by maintenance, they meant, going out and cutting grass and seeding seed and sodding and clipping bushes and planting flowers, putting out pine needles, picking up snow. We don't get a lot of snow around here, but you may get a lot where you live. And so you get my point that maintenance is taking care, maintaining the property. And it tends to be with clients that are bigger clients like homeowner associations, or perhaps it could be an assisted living facility or a business in the area. It could be the airport in your city. It could be the hospital. It could be fast food restaurants. It could be anything, any industry. So it's tends to be recurring revenue on an annual contract basis. So that revenue, the maintenance revenue, again, the cash flow rather, was worth 5 times that number. Versus the same buyer said, but we'll pay you only 3 times your cash flow for your construction cash flow or your construction landscape work. And construction is things like going out and helping put in the infrastructure of a new neighborhood and helping to excavate and to plant trees and flowers and shrubs in the new neighborhood. But once you're done with that, You move on to the next neighborhood because there's no recurring revenue. There's no maintenance. So again, the maintenance was worth 5 times cash flow. The construction only worth 3 times cash flow. That's an example of quality of earnings. Another example would be a CPA firm, let's say, that has $10 million worth of revenue, and is spread out among 1,000 individual business or business tax returns and bookkeeping on a regular basis, and payroll, and some audit work, and some other type of consulting work. So it's spread out over a lot of different product mix, and also a lot of that is sticky type of work that's recurring, required every year. The payroll tax stuff and the bookkeeping is done on a regular basis. Payroll has to be done sometimes as often as once a week. And so if the CPA firm doing $10 million a year has this a lot of sticky recurring revenue, like the bookkeeping, the annual audit, the annual tax returns that have to be filed for corporate and individuals, that is going to bode well for a high quality cash flow versus another CPA firm. Let's say that they just do tax returns. They do 1,000 individual tax returns, and they do 500 corporate tax returns. They generate $10 million worth of sales. That is not as sticky. It's going to be a once a year engagement with each of those types of clients, but it's not recurring maybe on a monthly or weekly or annual basis, or it is an annual, but not more regularly. And also, it's much easier for someone to just go to another CPA and get their tax return done, or have their corporate return done at another CPA. Much more difficult to move your bookkeeping or all your payroll, which can have hundreds of different employees and requires a lot more work on your part to move. But it's very easy just to go to some other CPA to have your individual tax return done or your corporate return. So again, that first CPA firm, $10 million and a broad product mix, a lot of sticky recurring revenue, that quality of cash flow is better than that second firm, where it's just 1,000 individual clients and 500 businesses, all tax returns. So first, again, is cash flow is king. Second is your quality of earnings. The third item I would point out to you is something that's very timely in the current economic cycle we're in, and that is your organized labor force. Your organized labor force often is it's unstated, but so valuable. Like, you're not going to find your organized labor force in your financial statements on your balance sheet. It's not an asset sitting there, but it is such a valuable asset. I would say it's probably the most valuable asset that you and I have as business owners. And so one of the things that we ask for as part of the valuation process is we ask for a list of all your employees, either your organizational structure, or you can, on our checklist that we send out, we ask for the names and titles of key employees, and how many hours of what they work a week, and what are their duties, and how long have they been with you, and what are you paying them. And that gives us an idea of how organized your labor force is and the quality of your labor force. And another thing, a little litmus test that I give for business owners, if I'm just talking to them, is I say, can you take a 1-week vacation and have the business, the employees run the business for you? Can they take the phone calls? Can they handle the everyday items that come up at your business? And the answer hopefully is yes. If it's yes, then you're on your way to having a good organized labor force, so a labor force that's valuable. If you can take a 2-week vacation, even better. And so the organized labor force cannot be stressed too much here. It is invaluable. So whether it's one employee that you have that's key or five, the more obviously is better, but you need at least one person that can run your business or help you run the business, so that you can go on vacation. So you don't have to be at the office all the time, or out in the field, whatever the case may be, or out in the factory. And so number one, cash flow is king. Number two, the quality of earnings. And number three, your organized labor force. Number four is your customer or your differentiation from your competitors. And what I'm speaking to here is, I would say, your secret sauce. What are those things that differentiate you? You may have spreadsheets that you've created that help you with processes to do them more efficiently, more effectively. It gives you a competitive advantage. If you're a restaurant owner, it could literally be your secret sauce. It can be your recipes. If you're a manufacturer, it can be your equipment. Do you have a lot of automation, or a lot of things still done manually? And so you have to think about your business and those things that differentiate you. And the more differentiation you have, the more intellectual property, the more favorable that is for cash flow and hence the business value. So I have enjoyed sharing with you today. Appreciate your time, and hope you'll tune in next time with me, Jim Turner, the business value guy. Thank you. Bye-bye.